Stop watching the 5-minute charts. Stop staring at RSI. Stop letting noise hypnotize you. What is happening today? January 6th, 2026 is not a correction, not a pullback, not a trade. It is a war. And this morning, we received the first official confirmation that the Western Front has collapsed. Ladies and gentlemen, Asian guy here, John Ag from Currency Archive. For years, we stood alone. For years, we warned that the silver price was a lie, that the vaults were hollow, that the banks were naked short. They laughed. They mocked. They called silver a pet rock. They told you to buy tech stocks, trust the system, and stay quiet. Today, the laughter stopped because the enemy didn't blink. They surrendered. We need to talk about Bank of America, not a blogger, not a newsletter writer, not a YouTube channel. One of the most powerful, most entrenched, and most aggressively bearish financial institutions on earth. For a decade, this bank told clients to avoid gold and silver. For a decade, they shorted the metals. For a decade, they dismissed anyone warning of shortages. This is the Death Star of the market. And this morning, the Death Star lowered its shields. Bank of America has officially capitulated. Let's look at what they just put in black and white. For years, they claimed gold was overvalued at $2,000. Now, their official average target for gold is $4,538 per ounce. Read that again. That isn't a bullish adjustment. That is an admission that fiat currency is dying. But they didn't stop there. They declared that gold should no longer be a hedge. They said it must represent 20 to 30% of every portfolio. Traditionally, banks recommend 0 to 5%. Going from 5 to 30 isn't strategy. It's panic. It's an acknowledgement that the other 70%, stocks, bonds, paper assets, is in mortal danger. But the gold call isn't even the real story. Silver is. This is the smoking gun. Bank of America finally ran the numbers we've been screaming about for years. They looked at history. They looked at geology. They looked at ratios. And they admitted something explosive. Silver isn't undervalued. It is coiled. Based on the 2011 ratio, they point to $135 silver. Based on the 1980 ratio, they project $300 plus silver. Let that sink in. The same institution that helped suppress the price is now publishing research that implies triple-digit silver. Why? Why now? Why flip after a decade of denial? Because they are trapped. They see what's coming, and they can no longer hide it. The paper game only works as long as physical metal exists to satisfy delivery. That metal is gone. In the same report, they quietly admitted the supply disaster. Global mine production is expected to fall another 2% this year. Costs are exploding. Energy is up. Labor is up. Equipment is up. At $70 silver, many mines were barely surviving. At $300, that's where production even makes sense. Bank of America understands this. They know price must rise or the industrial economy runs out of silver. They aren't switching sides because they want you to win. They're switching sides because they want to survive. They want to say, "We warned you," when price goes vertical. This is the moment every historic bull market reaches, when the biggest bear becomes the biggest bull. There are no sellers left. Only air above. But Bank of America isn't just looking at charts. They're looking east. Because the real reason the physical market is empty isn't Wall Street. It's Beijing. And to understand why the banks panicked, you have to understand the liquidity bomb that just detonated inside China. You cannot understand the panic inside Bank of America until you understand what just detonated in China. While Western media debates rate decimals, Beijing unleashed the largest liquidity event in human history. Not stimulus, not support. A monetary weapon. China expanded its M2 money supply by 48 trillion. That is nearly double the entire U.S. money supply. When America printed 5 trillion, inflation exploded. Housing doubled. Living costs went vertical. Now imagine a blast almost 10 times larger. But here's the critical difference. When the U.S. prints money, it flows into stocks, derivatives, and financial engineering. When China prints money, it flows into real assets, oil, copper, food, and most aggressively, gold and silver. China does not care about price in yuan. They care about ounces. If silver is $85, they buy. If it's $95, they buy. If it's $120, they buy. Because currency can be printed. Metal cannot. This is the black hole effect. No amount of paper selling in New York can stop a $48 trillion bid from the East. The price on your screen is theater. The physical flow is reality. And reality is winning. Which brings us to the number terrifying Western banks. 4.4 billion ounces. That is the estimated net silver short position of the banking system. The entire planet produces about 800 million ounces per year. They are short 5.5 years of global production to 550% of supply. They sold silver at $20, $25, $30, promising delivery of metal they never had. They never planned for China. Every single dollar silver rises now costs them $4.4 billion. At $100, losses are fatal. At $300, they are extinct. But money isn't the real problem. Delivery is. These shorts are promises. And today, the counterparty isn't a trader willing to take cash. It's China. It's solar manufacturers. It's the military. You cannot build panels or weapons with dollars. They demand bars. And when billions of ounces stand for delivery against nearly empty vaults, the system snaps. That's when banks are forced to buy into a market with no sellers. This is how prices gap. This is how charts break. This is how $80 becomes meaningless overnight. Which brings us to the $80 trap. The number on your screen is the price of a paper promise. Call a dealer. Try to buy physical at $80. You can't, because the real price is $90, $95, $100, and rising. That premium isn't greed. It's proof the spot price is broken. If COMEX were real, arbitrage would close the gap. It hasn't, because the metal isn't there. The banks want you to sell here. They need your metal to survive. Do not give it to them. Because when paper fails, price won't drift higher. It will reprice violently. Now the final nail, geology. Silver supply is falling 2% this year during exploding demand. Grades are collapsing. Energy costs are soaring. Mines take 10 years to build. Most silver is a byproduct. If the economy slows, supply drops even faster. This is structural scarcity. This is why Bank of America surrendered. They didn't change their mind. They ran out of options. So here is the final order. The system is breaking now. When the margin call hits, price won't rise politely. It will go vertical. $150, $200. No liquidity. In a melt-up, paper holders are erased. Metal holders become the new banks. Do not sell. Do not trade sovereignty for promises. Do not bail out the institutions that trap themselves. Soon the question won't be what's the price. It will be, is there any left? The argument is over. Now the transfer begins. Red alert. Hold the line.